Welcome, deep divers, to another journey into, well, the fascinating world of strategic thinking.
Great to be diving in.
Okay, so try and cast your mind back. It's 2002. The internet bubble had, spectacularly
A little
birthed.
chaos in the markets.
Right, markets were in free fall and uncertainty was just everywhere. In that kind of environment where most companies were just trying to keep their heads above water, how does a business talk about its vision, its challenges, and, maybe surprisingly, its resilience?
It's a tough ask.
It is. And today, we're not just looking at some dusty old document. We're diving deep into the Markel Group's 2002 Shareholder Letter.
A classic in its own way.
It really is. This isn't just an annual report. It's almost like a masterclass in navigating, well, really turbulent economic waters. So our mission today, to pull out the most important nuggets of knowledge, the real insights. We're going to look at how Markel tackled insurance, how they managed investments with a pretty unique philosophy, how they handled their corporate culture, and laid out their strategy for the long haul.
Yeah, trying to find those core principles.
Exactly. Think of this as your shortcut to understanding those principles that build long-term success, even when, the world feels like it's falling apart around you.
And the source is that 2002 shareholder letter itself. Comprehensive stuff.
Right? That's our guide.
And what makes this letter so interesting, I think, is precisely that backdrop. 2002. You said it, the letter calls it a very difficult market for investments. That's putting it mildly.
Yeah, direct quote.
It wasn't just a dip, it was a major reset after, frankly, years of irrational exuberance. Seeing how Markel acted then tells you more about their core DNA than any boom time could.
Absolutely. And in that environment, their strategic clarity really comes through, doesn't it?
It does.
The letter talks about their intense focus on several specialty product areas. They weren't trying to be everything to everyone.
No scattergun approach.
Not at all. And this focus went global. Notably, Markel Syndicate 3000 at Lloyd's of London, which, for listeners who might not know, is that unique historic market for specialist insurance. And also Markel International Insurance Company Limited.
And this wasn't just, sticking a flag on a map. It was a deep commitment. Putting the Markel brand on those London businesses, the letter says, signaled a long-term commitment to this market.
Right. It showed they saw these international ops as really integral, a core part of the whole Markel picture.
It speaks to a belief in diversification, in global opportunity, even when things looked pretty grim worldwide.
And what's really insightful, I think, is that they saw similar things happening on both sides of the Atlantic. The letter notes, the market environment for our international business is very similar to the opportunities we face in North America.
Parallel conditions.
Yeah, specifically mentioning the return of underwriting discipline and improved pricing. It's fascinating they saw those same strategic advantages playing out across different continents.
It really is. Now, interestingly, they actually saw gross premiums go down a bit in 2002.
Oh, right. Why was that?
It was largely due to some strategic restructuring. But they weren't just shrinking back in fear. They were sort of pruning deliberately, setting the stage, as the letter puts it, for opportunities to grow, develop, and take advantage of more favorable market conditions in 2003.
So not contraction for its own sake, more like repositioning, getting ready for the next phase.
Exactly. A deliberate move for future strength.
Okay, let's unpack a term Markel uses a lot and says is fundamental. Underwriting discipline. The letter stresses it's critical to their whole business model. So in an industry that's often tempted, to just chase premiums, what does this discipline really mean for Markel, especially back then in 2002?
It's everything. It's their heartbeat. They're non-negotiable. Underwriting discipline for them means really carefully assessing risk and then pricing that risk accurately, profitably.
So not just writing business to write business.
Absolutely not. It's having the guts to say no to business that doesn't meet their pretty strict criteria, even if it means lower top-line growth sometimes. In 2002, when everyone else was desperate for any premium, their discipline let them get improved pricing.
Oh, so they could charge more because others were pulling back or pricing badly?
Precisely. It's a powerful counter-cyclical move, the ultimate long-term play in insurance, really.
And yet, even with that discipline, the letter shows they weren't immune to big challenges. They took a hit. $69 million in underwriting losses from discontinued lines. And the biggest piece of that, a huge increase in reserves for asbestos claims.
Yeah, asbestos. The nightmare scenario for insurers.
It sounds like this just bottomless pit. A real quagmire, as they called it.
It was, and honestly, for many, it still is. What's interesting is how Markel adapted. For years, they'd done this bottom-up review, policy by policy. But by late 2001, they did this in-depth study of exposures from our international business up the reserves.
Okay, proactive then.
Proactive, yes. But then 2002 got worse. More claims, the letter says, particularly by non-injured claimants, plus more company bankruptcies. It just kept escalating.
Oh.
Now, Markel clarified they were a minor player in the asbestos quagmire. They weren't major insurers back when most of the exposure happened, but it still hit them.
It just shows how unpredictable those long-tail liabilities can be, doesn't it? Even the best analysis has limits.
A very stark reminder.
So even as a minor player, the ripples were significant. But then there's this other interesting case. France, their French reinsurance company. Its results were put in discontinued operations. Now, that term discontinued ops sounds like something failed, right? Like it's shut down.
Right, it often implies that.
But Markel's explanation is, well, more nuanced. It's subtle, isn't it?
It absolutely is. And this points to a common confusion between accounting labels and actual business reality. France has not been discontinued, they state clearly. Instead, it was held as available for sale.
So they planned to sell it, but it wasn't necessarily failing.
Far from it. Actually, it had very satisfactory results in 2002. Pulled in $26 million in net earned premiums. Why? Because of improved pricing and fewer claims in the reinsurance market at the time. The letter even praises its well-disciplined management.
So is this healthy?
Very healthy. It's a story of strategic portfolio management, not cutting losses.
Okay.
They were looking to sell a good asset, probably to redeploy that capital somewhere else. They saw better opportunity.
Okay, now here's where I think it gets really, really interesting. Markel's fundamental belief, and they state it plainly, sound investing is a critical part of our long-term success, and our performance in this area clearly distinguishes us from most insurance companies.
That's a bold claim.
It is. It's not just about collecting premiums, paying claims. It's about making their capital work hard, like a powerful engine for growth. Why is that emphasis so, well, relatively rare in insurance, and why is it so crucial for Markel's identity?
Well, most insurers, they focus primarily on underwriting profit. Their investment portfolio is usually managed very conservatively, mostly just to match their liabilities. Bonds, mostly safe stuff.
Right.
Markel, though, sees investments as a distinct long-term competitive edge. Think about 2002 again, that very difficult market. They reported an overall total return of 8.3% on our investment portfolio.
Which is remarkable for that year.
It really is, and that wasn't just luck. It was their philosophy in action, working precisely when it was most needed during a crisis.
That 8.3% is impressive. But let's drill down. Their equity investments actually lost money, 8.8%.
Correct.
A loss.
But, and this is the key context, the S&P 500 index lost a whopping 22% that same year. So yeah, a loss is a loss. But outperforming the market by that much, that suggests real skill.
Huge outperformance. And they're very clear. We do not manage against this index, nor do we think in relative terms. That's crucial, isn't it? It tells you everything about their mindset.
Yeah.
They're not playing the relative performance game against an index. They're playing an absolute game, looking for fundamental value.
Exactly. Now, their fixed income, their bonds, that was the steady hand. A total return of 9.8%, which was in line with the comparable indexes. And critically, they'd avoided all of the credit problems of the technology sector blowups.
Smart move. So discipline across different asset classes.
Right, a clear philosophy for each part of the portfolio.
And you really see that long-term view in the 10-year returns they included in the letter. It showed how their bonds and stocks performed against the benchmarks over a whole decade.
Yes, smoothing out the cycles.
It wasn't just one good year. It highlights the significant value they believe they added through sound investment discipline over time.
And this gets us to maybe the core of their investment thinking. We don't think of our investments as paper to trade, but rather as equity ownership of real businesses.
That sounds familiar.
Yeah.
Very value investing-esque.
Straight out of that playbook, it means they're not just betting on stock prices going up or down. They're buying into the actual economics, the management, the long-term prospects of the companies themselves, looking for that compounding effect over years.
It does sound a lot like a certain investor based in Omaha we talk about sometimes. Now, interestingly, their actual equity allocation in 2002 was lower than normal. Why was that?
The letter gives a few reasons. One, their portfolio basically doubled in size with the Markel International acquisition back in 2000, so they needed time to digest that and build the balance sheet.
Okay, makes sense.
And two, they genuinely had trouble finding great opportunities in equities as stock prices soared in the late 90s mania, which shows real patience, right? They didn't just chase the market up.
Resisting the frenzy. So what was the allocation then in 2002?
At year-end, the equity portfolio was $551 million. That was about 13% of our total portfolio and 48% of total shareholders' equity.
And how did that compare to what they'd prefer?
It was below their stated preference, which was more like 20% to 25% of the portfolio or 75% to 80% of shareholders' equity in stocks.
Big difference.
Yeah. And their intention, clearly stated, was to increase that allocation when they found quality opportunities at favorable prices. Classic value investing. Be ready to buy when things are cheap, when others are fearful.
And it wasn't just about equities. They were also thinking about risk in their bond portfolio. They flagged the risk of declining value in fixed income securities should interest rates increase, given how low rates were then.
Which turned out to be very prescient over the next couple of decades.
Indeed, their strategy. To minimize that risk by being cautious in the duration of our bonds, basically holding shorter-term bonds to reduce sensitivity to rising rates.
Always thinking about risk management, even in the supposedly safe assets.
Okay, so let's pull these threads together and look at their overall financial health picture in 2002. Despite that tough market, Markel reported strong growth in written premiums. And get this, a 20% increase in our total investments in cash to $4.3 billion.
That's a significant jump in assets. Tells you a lot about their operational momentum.
How did that happen? Where did that $723 million increase come from?
It wasn't just one thing. A big chunk, $507 million, came from operating cash flow. That's their underwriting discipline paying off right there.
Cash generated from the core business.
Exactly. Then another $102 million came from increased debt, which they specifically used to add capital to their insurance subsidiaries, plus some foreign currency gains. So a multifaceted approach to building capital during a downturn.
And this growth led to their investment leverage increasing. It went up to 3.7 times as large as shareholders' equity, up from 3.3 times the year before. The letter calls this leverage important to our financial model. What does that increased leverage signal to you?
It signals confidence, I think. They're comfortable using prudent debt to amplify the returns from their investment portfolio, especially if they see good long-term opportunities emerging from the market dislocation.
Calculated risk, then.
Calculated risk, yes. But it's backed by their strong underwriting and that long-term investment view. Now, for a strategy like that to work, you absolutely need sound loss reserving. That's critical.
The foundation.
Absolutely. And their stated goal is to set reserves more likely redundant than deficient, meaning they'd rather set aside too much for future claims than too little. Build in a cushion.
Which sounds incredibly prudent. Very conservative. But they were also really candid, weren't they? They admitted that in 2002, they failed to achieve this goal in certain areas, specifically asbestos again, other discontinued lines, and some casualty losses.
That level of transparency is powerful,
Well,
admitting where things didn't go perfectly.
It really builds trust, doesn't it? Saying, look, we aimed for this, but here's where we fell short.
Exactly. They describe reserving as more art than science and acknowledge it's subject to unknowable future events, no matter how careful you are. Yet they still believe their overall year-end reserves met their goal. That combination, the candid admission, plus the overall confidence, it underscores their culture. No sugarcoating.
They also pointed to a big pile of gross unearned premiums, $937 million, with $718 million net after reinsurance. They expected this to flow through as future profits.
Yeah, that's basically revenue already booked but not yet recognized. Thanks to those price increases and solid underwriting, assuming no huge disasters hit, it's a strong indicator of near-term earnings power.
And despite all the headwinds, shareholders' equity still grew. It reached $1.2 billion, or $118 per share.
Still moving forward.
Though they did note the growth was only 6.7% for the year and directly stated, we need to do better, and we will. That self-critical assessment, again, it speaks volumes about accountability.
No resting on laurels, always aiming higher.
And one more proactive move in early 2003, just after the year end, they issued $200 million of 10-year notes. Why? To repay bank debt and pre-fund some other debt coming due.
Smart financial management. Extending their debt maturities, locking in rates, boosting liquidity after a tough year shows they're always thinking several steps ahead.
Okay, Let's shift gears slightly. Something really bubbling up in 2002 was corporate governance. Post-Enron, post-WorldCom.
Huge topic back then. Sarbanes-Oxley was on the horizon.
Exactly. The letter says corporate governance issues have become an important topic. Now, Markel already had this long-standing approach, building relationships with shareholders, family, friends, and neighbors, as well as institutional investors.
Yeah.
How did that history shape their view on this new governance push?
It was absolutely foundational for them. They weren't just reacting to scandals or new rules. They felt they were already living the principles. What's fascinating is they explicitly cite inspiration from Berkshire Hathaway's owner-related business principles.
Ah, the Berkshire connection again.
Right. They tell shareholders, essentially, visualize yourself as a part owner of a business that you expect to stay with indefinitely. That's not compliance language, that's partnership language, a deep philosophical alignment.
And that led to their distinction between long-term share owners.
And short-term share renters who are, quote, just trying to catch a wave.
I love that phrase, share renters. It's not just semantics, is it? It's a filter for who they actually want as investors.
It's a powerful cultural statement. Look, they acknowledge the recent abuses leading to new laws and regulations, but they were a bit skeptical.
How so?
They worried some companies would just follow the letter of these new rules and do nothing to live up to the spirit, and that many requirements would just add cost without any benefit. Markel basically asserted, we've always met the spirit of good governance. We don't need new rules to tell us how to act.
A principled stance.
A very principled stance based on the belief that true governance is internal, not just imposed externally.
And they backed it up with their practices, ensuring shareholders get their fair share and not be exposed to any management haircut. Their decision years earlier not to issue dilutive stock options. That was pretty radical back then.
Very contrarian. And they talked about having logical and rational bonus plans that correctly align our associates' performance with shareholder value.
They also mentioned their stock loan plan for employees. They saw it as better than options for creating real ownership.
Yeah, but there was a funny quirk with the new rules. The loan plan, which they preferred, became unavailable to top execs and directors, while regular stock options were still fine. They pointed this out as a bit inconsistent.
An example of how rules can have unintended side effects.
Exactly. Good intentions, maybe, but sometimes awkward outcomes.
And they didn't just rely on past practices. They actively strengthened their board, bringing in Jay Reinberg as an independent director noted for excellence and integrity, adding real value, not just ticking a box.
Reinforcing their standards from the top.
So let's look forward from their 2002 perspective. The letter ends on a remarkably optimistic note, doesn't it? They say Markel is truly in a unique position to benefit from the changes in the insurance world and to capitalize on everything they built. Why so confident after such a bruising year?
Well, it came back to all those core principles we've been discussing. They saw strong insurance prices continuing. They saw standard insurance markets continue to tighten their belts and send more business to specialty carriers like them.
So market trends were moving in their favor.
Right. Plus, their own house was in order. Their reserving and accounting aimed to reduce unfortunate surprises. Their investment portfolio was growing and guided by that distinct philosophy, which they felt boded well for future prospects. It was this convergence of disciplined operations and favorable market positioning.
And it wasn't just about the financials of the market. It was about the people, too.
Absolutely. They highlighted having one of the best teams in the industry, possessing the intellectual capital necessary to compete successfully. And alongside that, the promise that shareholders will get a fair shake. It's a picture of strength built on culture and people just as much as the balance sheet.
Okay, so as we wrap up this deep dive into Markel's 2002 letter, let's quickly recap the big themes. We've seen that relentless focus on underwriting discipline, that distinctive long-term investment philosophy thinking like owners, not traders.
Crucial difference.
Transparent, really candid communication with shareholders, even about the tough stuff. And this deep-seated commitment to genuine corporate governance beyond just rules and regulations, all playing out against that backdrop of market turmoil and regulatory change.
And understanding how a company like Markel navigated that period by sticking so firmly to those core principles, well, it offers really valuable lessons for you, doesn't it? Whether you're an investor running a business or just trying to figure out how resilience and long-term value actually get built, it's not accidental.
Not at all. And here's a final thought to leave you with, something to mull over. The letter openly states that reserving predicting future claims is more art than science and is subject to unknowable future events.
Acknowledging the limits of knowledge.
Exactly. If even a company this disciplined explicitly acknowledges the unknowable right at the heart of its business, what does that tell us about the blend you need? That mix of rigorous analysis and an adaptable philosophy, maybe even some humility, needed to thrive in any environment. And maybe more importantly, how can you apply that perspective, embracing both the known and the unknowable in your own decisions, personal or professional?
That's a great question to ponder. That balance is key.